Something just changed in the bond market, and it directly affects every dollar you have sitting in cash. Short-term bond yields have now risen above what cash pays. That gap has been widening every week, and most everyday savers have no idea it is happening. This week, the Federal Reserve's preferred inflation gauge moved further above its 2% target. Markets responded immediately. They started pricing in higher interest rates for longer. Some are even pricing in a rate hike before the end of the year. And buried inside all of that market movement is a shift that creates a real, practical opportunity. One that applies to you whether you have $500 sitting in a savings account or $500,000 in a money market fund. Let me explain exactly what changed, why it matters, and what you can do about it right now. The Fed watches something called the PCE price index. That stands for personal consumption expenditures. It is the inflation measure the Fed trusts most. This week, that number moved further above 2%, not dramatically, but enough to shift the conversation inside the Fed completely. Here is where it gets interesting. Core PCE, which strips out food and energy, has risen more modestly, but it is still above target. Services inflation has not reaccelerated in a clear way. That actually matters, because services inflation is the sticky kind. It is rent, healthcare, haircuts, prices that do not fall easily. The fact that services inflation is holding steady is the one thing keeping the Fed from an immediate hike. But it is a fragile balance, and markets are not waiting to see how it resolves. They are already pricing in the worst case. Now here's the practical part. When markets expect rates to stay high or go higher, something specific happens to short-term bonds. Their yields rise, not because the Fed raised rates today, but because investors demand higher returns to compensate for the uncertainty. And right now, short-term bond yields have risen above what you earn keeping money in cash. That is the gap that just opened up. Think about it this way. If your savings account is paying you 4.5%, and a short-term bond is paying 5.2%, the difference feels small. But on $50,000, that gap is $3,500 a year. On $100,000, it is $7,000. That is real money, and most everyday savers are leaving it on the table. Now let me address the question most people have immediately. What even is a short-term bond? A bond is simply a loan you give to a government or company. In exchange, they pay you interest. Short-term means the loan comes back to you within 1 to 3 years. You are not locking your money away for decades. You are parking it for a defined period and collecting a higher yield than cash while you wait. The most common short-term bonds are U.S. Treasury bills and short-duration bond funds. Treasury bills are backed by the U.S. government. They are among the safest financial instruments in the world. And right now, they are paying meaningfully more than a standard savings account. If you enjoy breaking down markets and money, subscribe for future updates. Here is the part that most people in mainstream finance skip over. This yield advantage only exists because the market believes rates will stay elevated. And the market believes that because inflation is not cooperating. PCE is up. The Fed's own dot plot, which shows where policymakers expect rates to go, was revised this week. The previously expected 2026 rate cut was removed. Let me say that again. The Fed just erased a rate cut from its own forecast. Half of Fed officials now expect at least one rate hike before the year ends. The other half expect rates to stay flat. Nobody at the Fed is talking about cuts anymore. And new Fed Chairman Kevin Warsh has already signaled publicly that inflation needs to be handled. This is not a rate-cutting environment. This is a rate-holding or rate-hiking environment, and in that environment, short-term bonds perform better relative to cash than in almost any other scenario. Now here is what most investors get completely wrong about this moment. They wait. They assume this opportunity will still be there in 6 months. Sometimes it is. Sometimes the window closes fast. When the Fed eventually pivots, when inflation finally cools enough to bring rate cuts back to the table, short-term bond yields drop, the yield advantage over cash shrinks, and the people who waited miss the entire opportunity. We do not know when that pivot comes. Could be late 2026, could be 2027, but the conditions that create this yield advantage do not last forever. And right now, those conditions are as strong as they have been in years. Let me give you 3 practical things you can actually do this week. First, check what your current savings account or money market fund is actually paying, not what it advertised 6 months ago, what it is paying today. Cash yields have declined as the Fed cut rates over the past year. Some accounts are still trailing what short-term bonds offer. Second, look at Treasury bills directly. You can buy them through treasurydirect.gov with no fees. You can also buy short-duration Treasury ETFs through almost any brokerage account. Tickers like SHI or BL track short-term U.S. Treasuries, low cost, highly liquid, and currently yielding above most cash alternatives. Third, think about laddering. This is a strategy where you split your money across bonds with different maturity dates, some coming due in 3 months, some in 6, some in 12. This way you always have money becoming available. You never feel fully locked in. And if rates rise further, you can reinvest at higher yields. There is one more thing worth understanding here. This is not just about earning more interest. It is about positioning yourself before the narrative shifts. Markets are currently pricing in a higher Fed funds rate than the Fed itself is projecting. That is an unusual condition. When markets price in more tightening than the Fed plans, something eventually snaps. Either inflation comes down and the Fed pivots faster than markets expected, or inflation stays stubborn and the Fed has to hike. Either path creates volatility in stocks, and in both paths, short-term bonds offer something that stocks currently do not. They offer certainty. You know the yield when you buy. You know when you get your money back. In a market where half the Fed is debating whether to hike and global tensions around Iran are still unresolved, that certainty has a real value. This is one of those moments in the market. The people paying attention now will thank themselves later.